with lesson 2, I believe, and I wanted to talk a little bit more about appropriations of retained earnings, because we covered them just a tad in the first lesson, but we cover them more now here, and after looking at the book, I don't think it covers it adequately for what is required in our assignment. So first of all, appropriation of retained earnings is a journal entry, and that's quite interesting. Let me see if I can find that. I have an example of it. So retained earnings is a group, it's a accumulation of net income and other additional paid-in capital, or not additional paid-in capital, but other funds that have come into the company through the profit stream. And it is not an indication of the amount of money allowed or the amount of money available for paying bills. It's an indication of how the company has accumulated net income. It also is a very big indication of dividend policy. So if you have a very large retained earnings, it kind of reflects how much dividends that you distribute to your shareholders, because that's a direct deduction from retained earnings. So what we want to look at is many times when we have a lawsuit coming up, maybe, or maybe we have borrowed money from a bank or a bond, they will ask us to appropriate retained earnings. And what that means is you're going to make a journal entry that takes a certain amount out of retained earnings here and puts it into an appropriation retained earnings, and it tells what it's for. Now, when that project has either been completed or those appropriations are no longer required, that entry, as you can see, is reversed. So first of all, that's how it gets established. Now, the other thing that the book doesn't show you, and I think this is really important, is how to record or how to present that to your shareholders. And I found this, and I thought it would be really helpful, is here is your journal entry right here. And then on the balance sheet, this can be shown down here. Here's retained earnings. We show appropriated per loan agreement. You see this? And then it shows unappropriated retained earnings. And then it completes the statement of owner's equity. Another way of doing that, rather than put it on the equity side, is just to make a note in the disclosure notes of retained earnings are restricted by this amount of money. And it's under notes to the financial statements. So those are two ways of showing and presenting and telling your investors what is going on with your retained earnings. It's a very good way to be transparent. So that kind of explains appropriations of retained earnings, and it also shows you how to present them to outside stakeholders. So now let's move on and look at earnings per share, which is part of this this chapter and the assignment that you have to do. So you're going to look at earnings per share. We're going to look at the return of a rate of return on common stock, or this is sometimes called return on equity. And we're going to look at the price earnings ratio, or the PE ratio. And you're going to hear that over and over and again when you start doing investment analysis and looking at your stocks. So let's kind of mosey through this stuff. We're always comparing a company's profits because maybe somebody else has a better profit. We want to know, one, why ours isn't that good if they're in a similar business, or two, if we want to invest in that company. So there are three important ratios that are used for that, and that's that earnings per share, the rate of return, and the price earnings ratio. And all of these are very easy to do. They're all equations, and they all come off the financial statements. So, and the earnings per share is found on the tail end, the final part of a corporate income statement. In fact, it must be there. It is required by the SEC. So, and the equation, here's an example, okay? Here's the equation, first of all. It is net income minus preferred dividends divided by the average number of common shares outstanding. Now, that means you're going to take the beginning share and add the ending shares and divide that by 2 to get the average. So, and as you can see here, we don't have any preferred dividends, so we take the full amount of income minus 0 and then divide it by that average to come up with $3.19 per share. Very easy to do. Now, remember that number because you're going to need that for the PE. So now you can do a price earnings ratio. And that basically tells you how much they should be paying for each dollar of company earnings for a share. And it's really kind of easy. Let's say your earnings per share, the market price of the stock is $75, okay? The earnings per share is $3.19. If I divide the market price by the earnings per share, it gives me this 23.5, which means for each dollar of earnings that I have off of the earnings per share, I should be willing to pay 23.50 cents for a share. So if you multiply that out, you'll come up with $75 per share. And then you can compare that to other companies. What is their PE ratio? And the final one we'll look at is rate of return on common stock or equity. And again, that's a really easy equation. It's net income minus preferred dividends again, divided by average common stockholders' equity. Now we're looking at the dollars, not the actual number of shares. So again, you take the beginning and the ending equity and divide it by 2 to get the average, and then divide that into your net income to come up with a return on stockholders' equity of 20%. Again, is that good or bad? Well, I don't know. I mean, 20% looks wonderful, but how is the rest of the industry doing? Are we on the benchmark? That's how you would compare it. So that kind of explains what we use all of the information we have and we find on the income statements and balance sheets. We use those to do analysis, to compare our company to another company, or to compare stocks so that we may invest in another stock. So I hope this has helped. You may want to replay this so that you can see how appropriations are recorded both on the balance sheet and or in the notes to the financial statement. Have a good day.